Hey everybody, Mike Drutar, principal broker over at NextHome Paradise Realty in Kona, bringing you a market report. We're going to take a look at the month of June 2022 as well as the second quarter of 2022. I know a lot of people think that the market might be crashing. We're going to take a look at where we've been in the last few years, where we are now, and where we might be heading. And I want to kind of paint a little bit of a more optimistic picture than you might be reading out there and seeing. I think if you take a look at the numbers and see where we could go in a worst case scenario, we'd actually still be pretty well off. We're also going to talk a little bit about interest rates and what you need to know about pending federal interest rate hikes and how those relate to the mortgage market. It might not be quite as direct as you might think, so stay tuned for that. Okay, let's get right into the numbers. First, we're going to look at the changes in the units sold in our market. Most of the time you're going to find that demand changes first and price changes second. Why is that? Well, price is a function of supply and demand. So when we see supply and demand changing, then you see price changing. So we always want to look at the numbers of units sold just to give us an idea of where things are headed. The challenge comes, and this is what's been a problem over the last few years, the challenge comes in determining if the lower numbers that happen from time to time are a result of a supply side problem or a demand side problem. And usually we can tell just by looking at some other data of availability. Over the last couple of years, we've been seeing numbers going down in terms of sales, but it's not because people haven't wanted to buy. It's simply because there hasn't been anything for them to buy. We're starting to see some balance come into the market, which is much needed. So you have to make sure that you're looking at it with the right lens. There's no steady or tried and true rule that this applies in all situations or this applies in all situations. You really have to get into the nuance, and that's what we're doing right here. So first off, we're going to look at the North Kona residential market. And again, this is for the month of June. We had 44 sales, and that is 9 fewer than in June of 2021, a decrease of about 17%. For North Kona condos, we had 43 sales. That was a decrease of about 32%, 21 fewer than before. Heading up the coast a little bit, we're in South Kohala now. 22 houses sold, that's down 8 units. 32 condos sold, that's down only 3 units. So up in South Kohala, we had a total of 11 fewer units sold between houses and condos. And here in North Kona, we had a total of 30 fewer units sold in terms of houses and condos. Now, is that supply side or demand side? I would say that most of the time we're seeing it, that is still a supply side issue, though we are starting to see a few more listings than we had before. So that part's kind of, we're starting to see some of the balance. How is that impacting prices? So we're going to look at the prices now for June. The important thing to remember here is this is going to cover June 1st through the end of June. So if you have a closing that happened at the very beginning of June and it was a financed offer, that's actually a contract that was written back in mid-April. So when you're looking at sold data, you're looking at old data, and that's something to always be aware of when you're looking at pricing. That doesn't mean it's the price of something now, especially if you're in a big inclining market or a big declining market. In North Kona, the residential median price was $990,000. That's an increase of 10.6% over June of 2021. Condos, median price $570,000. That's an increase of 41% over June of 2021. South Kohala condo market, $984,444 was the median price, an increase of 20%. And for residential, $950,500, increase of 14%. So we can break this out into a couple different markets here. I would say look at the residential numbers first. We saw a 10% increase in Kona and a 14% increase up in South Kohala. And then look at the condo numbers. 41% increase in North Kona, 20% increase in South Kohala. And why is this? I think the people are getting into the condo market a little bit more because, one, it's easier to get into in terms of pricing, but the other thing is it's easier to cash flow a condo in terms of doing a short-term or even a long-term rental than it is with a house. And so I think we're seeing still a lot more demand there, because one thing that's happening in an inflationary cycle is that you want your money to start making money instead of just sitting. And so I think we're seeing a little bit more demand. I think we're going to continue to see some more demand there. Next thing we're going to look at, this is where I kind of like the data a little bit better. We're going to look at the second quarter of 2022, and the reason I like having this sort of a data set is that it's just a lot larger. Monthly swings get taken out. We're also going to cast a little bit of a wider net here. So let's look at the entire Big Island for a second. The units sold for the second quarter of 2022, we have 752 sales. That's a decrease of 9.4% from the previous year. And then we're going to go and look at the median price for the entire island, $500,000. That's an increase of 4.6%. So we're seeing a little bit of flattening island-wide. Now let's get into our markets here in North Kona and South Kohala. Units sold, and this is for a 3-month period in North Kona, residential, 138 sales, that's down 24%. 131 condo sales, that's down 37%. We have 55 houses sold up in South Kohala. That's a big decrease, 41.5%. And 99 condos sold, a decrease of 23.2%. So we're seeing decreases here in units sold, and I think is a little bit of both in terms of supply side problems and demand side problems. I think there's not a lot out there to buy still. But you're also seeing, I think, in this big of a data set, a little bit of the slowdown in the buying. And what's happening is that a lot of the people who have cash and who have wanted to buy have already bought. And so you're seeing a few more people, a higher proportion of people who are doing it through financing. And financing prices, or the cost of financing, is going up. That's something we'll talk about here in a minute. Let's look at the median price. So we saw median price for the island in terms of houses going up 4.6%. What's it doing here in our market? Residential median price, North Kona, for the second quarter of 2022, $1,112,500. That's an increase of 17.3%. The condominium market in North Kona, $550,600 median price. That's an increase of 37.65%. All right, let's go up the coast to South Kohala. Houses, $950,000, an increase of 14.5%. And condos, $1,126,500 is the median price, an increase of 44.42%. So again, we're going to break this out between houses and condos. Houses, North Kona, 17% increases. Condos, 14.5% increases. And then we go to condos, North Kona, 37%. South Kohala, 44%. That's not a market that's crashing. So you may see our numbers slow down. Like, we may see that the third quarter of this year ends up being flat or even a little bit low in terms of median price compared to the second quarter of this year. But when we're looking at year-over-year gains, like what did you make last year? What was your return? The worst number we have here is 14.5%. That's good any year ever. So you're doing pretty fine on this. So don't buy the hype that the market is crashing. There are people out there that are going to tell you this, and they're using fear-based marketing. Whether you're watching this on YouTube or there's an article that you're reading, they're going to have a real flashy headline or really pretty thumbnail that usually has some kind of bright red text and an alarming looking face or something like that to try and convince you that things are awful and really bad, and they're going to pick and pull data. And you're going to see people doing things like looking at data last month when the median sale price was $1 million, and this month the median sale price is $950, and they're going to spin that as the market's crashing. That doesn't mean the market's crashing. You have to be careful of small data sets, but most importantly, you want to look at this stuff as year-over-year numbers. Now, with all of that said, the market is changing. It's not the same market it was 9 months ago. There is more balance in the market. There are fewer buyers. The buyers are kind of at their limit as far as aggressiveness. There are more sellers who are feeling comfortable listing their properties now, so you're seeing more options on the market. And that makes a lot of sense. If you're the seller with a commodity as desirable as a house right now with a nice pool and an ocean view, if you were to list that a year ago, you would have made money and you would have been happy. But at the same time, you're wondering if you're leaving money on the table by not waiting because things were going up so fast. There's so much acceleration. And waiting wasn't a bad strategy because in a year you might sell it for 20% more. And if you're talking about a $1.5, $2.5 million house, that's a lot of money. The fear of leaving money on the table by selling too soon, that's going away because things are flattening out and there's a little bit more balance. And so that's going to help. And we've said before, and this is something from Keith Robinson, the cure for higher prices is higher prices. Eventually, supply and demand kicks in. The prices go up so much that people are bailing out of purchasing, and that impacts the supply and demand curve, and then you start seeing a little bit of normalcy in the market. So things are changing, and one of the things that's causing things to change is interest rates. There are a lot of people who are still borrowing, and even if someone's not a borrower and they're paying cash, they're competing against people who are borrowing money, and that changes the dynamic of the competitive market that they're in. However, this is something to be really aware of. When you see that the Fed is raising interest rates, that does not necessarily mean a change in mortgage rates. So the first thing is to understand what it means when the Fed says that they're raising interest rates. First of all, they don't have direct control over the mortgage market. It's completely independent. What they're changing there when they raise interest rates is the federal fund rate, and it applies to loans between big banks of less than 24 hours. That is a completely different product than a 30-year loan. So if the Fed says we're going to raise things like they did earlier, just recently, 75 basis points, which is 0.75%, or what they may be doing here very soon, a full 100 basis points, which is what people are thinking, a full 1% increase, that doesn't mean you're going to see a mortgage go up 1% the next day. First of all, most of these big lenders kind of work these numbers in. They kind of read the tea leaves from the Fed, and they have an idea of where things are going. And so they start pricing things in ahead of time. But what we're seeing right now is actually a spread. And you may have seen interest rates go over 6% for a little bit there. They've settled back down sort of around the 5.7, 5.8%, which is still really good. You may see interest rates from the Fed go up another percent. But that doesn't mean you're going to see the mortgage go up another percent, because the people who are lending money don't think that this inflationary cycle is going to go on for a very long time. And they're selling a product based on where they think interest rates are going to be for the next 30 years. So when you see a 1% increase in the federal overnight lending rate, that doesn't mean there's going to be a 1% increase for you for the next 30 years. And you're starting to see that spread really happen now. And I think you're going to see it really come into play here in a few weeks when the Fed does raise the overnight rate 100 basis points. That's a full 1%. I think that's kind of what everyone is expecting. And if that's what they do, watch the interest rates. I don't think you're going to see them go up a full percent. So understand, while they are correlated, they are not directly related to each other. They're actually things that are a little bit different. And don't get too alarmed when you see the Fed raising their interest rates. The only real big difference that you're going to see is if the Fed is changing its bond buying plans. Now, those bond purchases, they actually do have a very direct impact on mortgage rates because they include the bonds that underlie the mortgage market, as well as other long-term bonds that move in concert with mortgages. So you have to be really careful on seeing what they're doing. If you hear about big changes in the bond buying plan, that can have an impact, but the rates themselves that the Fed charges, that does not have a direct impact. And remember, the Fed only meets, I think, 8 times a year, 10 times a year. Mortgage rates change every single day, throughout the day even. So, there's a big difference between those two markets. So don't get them confused, and don't get discouraged when you see things going on. Now, let's take a look here. I want to talk about where we've been and where we're going. For the people out there who think, "Oh my gosh, we're about to see a crash," I'm thinking, well, what does that mean? And I've talked to people, and they said, well, if it goes down 20%, that's a crash. I mean, we're back to where we started. And I thought, well, that doesn't sound right, but let me run the numbers. So I'm going to run some numbers here for you just to give you a little bit of perspective as to where we've been, where we are right now, and what does a worst case scenario look like. So starting with the fourth quarter of 2019, so the last truly clean quarter before the whole world changed, the median price of houses for North Kona and South Kohala combined was $651,000 here. In the second quarter of this year, for those two markets combined, the median price was $1,032,500. That's an increase of $381,500 or 58% in just a couple years. So what if we did go down 20% right now? Okay, 20% decrease from the 1.032 median price now. That would bring us down all the way to $826,000 median price. That's still 26% higher than we were at the fourth quarter of 2019. So even if we do see a crazy 20% correction, which I think we could probably see something maybe like more like a 10% correction, but if we did see a 20% correction, we're still in really good shape, guys. Like 26% on real estate over, 2.5 years? That's gold, man. That is great. Sign me up for that for the rest of my days on this earth, and I'll die a rich, rich man. So don't worry quite so much about where things can go. Even if we do have a big correction, we're still doing quite well, and you still have a lot of equity. The one thing I would caution people against doing is needlessly taking the equity out of their home if they don't really need it. Live within your means, build your equity up, and when it's time to sell, have a nice, big, huge stack of cash because you've been really diligent and not going after that equity. You're going to see a lot of people trying to get you to refinance your home with some very, very creative mortgages coming up because they're in the business of borrowing money. They need to entice you to do it. They're not going to be able to entice you to do it with low rates. So now they're going to entice you to do it by unlocking the equity and giving you a bunch of cash. Here's $250,000. Let's just do a refi. So get ready to see some of that and on 5-year arms and things like that. But if you have the ability to live within your means currently, I would encourage you to do that. Maintain your wonderful 2.5-3% interest rate that you probably got a year or so ago. And that will allow you to be much more financially independent for a really long time. All right, I hope you've enjoyed this market report. I'll try and bring these to you a little bit more, but the algorithm at YouTube is telling me that you guys don't like these videos as much. I don't get as much traction on them. So I'm going to put these out as much as you guys like them. Like, comment, subscribe, listen to them all the way through. If I see we're getting a lot of traction, I'll keep doing these. And I hope you guys do well. See you again real soon.